Todd, how you doing today?
Very good. How you doing?
Doing good. I appreciate coming on the Life After Business show.
Well, thanks. Thanks for having me.
So I am really excited for today's episode because, as the listeners will know, we met each other at one of the exit planning summits, and I got to watch your breakout. And you've got a very interesting background, and I couldn't wait to reach out to you and kind of pick your brain, but also hear some of the expertise and the stories that you've got. And before we kind of kick it off, we want to give the listeners a little bit of a background of your expertise and then also integrated wealth and where you guys play today in the market.
Sure. So our firm actually has been around for over 40 years. It was founded by an individual who had been a trust investment officer at a major bank, and then approximately 16 or 17 years ago, I joined the firm. And the firm was originally a wealth management firm. But very quickly, because I have a legal and tax background, our clients began asking us about tax planning and estate planning and also serving as trustee. And so very quickly, the firm began to take on these other service roles. And eventually, it became clear to us that our big value add was in the area of tax planning and trustee services, and we began to divest our investment arm. And so, really, now for a fair number of years, our focus has been on the tax planning and trustee services. And then, in particular, where our real focus is on the sellers of middle market companies. And you might say, well, why specifically that? Well, as it turns out, 70% of all wealth in the United States, now this, I'm going to tell you, defies common belief, but 70% of all wealth in the United States is in the hands of first generation business owners. It is not the elite families, because usually the kids blow the money. So only about 5% of all wealth in the United States is held by, what a lot of political people call the elite families. Only 5%. There's a huge attrition rate within family wealth. So it became clear to us that if we wanted to really focus on preserving wealth, it was on helping these middle market business owners maintain their wealth. And the big attrition comes with taxes. So that's kind of how we evolved.
And that word, I think, always perks up everybody's ears, especially the middle market or anybody that owns a business, right? Because taxes are the things that it's really the one piece that makes or breaks it or swings the needle.
Oh, sure. And, just to tell a quick war story, we had an individual call, and, there's ways to hold your ownership in a business. There's a way to structure the business itself, whether it's a corporation, a C Corp, S Corp, LLC, whatever. And what had happened was this gentleman's father had died. The father had owned a business, and at the end of it, they were going to see about 40 cents on the dollar of the value of the company between the estate tax and all these other things combined. It was just really a mess, and it's a crying shame. That's all I can say is I mean, that's kind of the harshest example is 40% net proceeds. So
and it's enough that's a big enough gap to have some specific attention to. And, so you mentioned when you were kind of explaining your firm about the preservation of wealth. And I think that term gets used so much, but I know what you do is so comprehensive and so detailed. But can you give our listeners your definition of preserving wealth?
Well, so as I mentioned, we are not in the investment business, and so whoever the individual's investment person is, they have their version of wealth preservation. So what we do is we help families to structure the ownership of their business for asset protection purposes. Okay, so if individuals get sued or whatever, we protect the ownership of the business from potentially opportunistic litigants. And then the second thing is to help preserve in terms of tax mitigation. Oftentimes, so let's just take a California resident, because California is kind of the poster child for tax.
It's the most beautiful examples when you're given the case studies, isn't it?
Yeah. So if we're talking about a pure capital gain scenario, so we're not, and I'll get into this in a second, but if it's just a pure share sale and all we're looking at is capital gain tax, a California resident between state and federal are going to pay about 34% combined tax on the gain. And so one of the things that we would do is to reduce that combined tax rate to, let's just say, 24% on gain. Now that's the sort of the simplest sort of example where we might be able to eliminate state level income tax. The second area, and I'll throw out another example, there was a gentleman who owned a garbage company. Not sexy, but it was a cash flower, let me tell you, in the Midwest. And the thing was that he had a lot of accumulated depreciation, both in real estate and then property and plant and equipment, a lot of trucks. And when you sell depreciated assets, you have recapture. Now, on real estate, recapture is a different rate than on non-real estate recapture. But in either case, it's higher than the capital gain rate. And when the gentleman's CPA told him how much in tax he was going to pay, he said, I'm not selling. I can't afford to pay those taxes. I mean, and the effective tax rate for him was going to be close to 50% on the recapture portion. So there's things that you can do to mitigate that, to change that from, we'll just say, this recapture rate down to a capital gain rate. And so these are examples where tax mitigation is reducing the effective tax rate. It's not the elimination of tax, but it's the reduction of tax.
Well, and I want to dive into that because at the breakout session, as I was watching your presentation, and I think probably a lot of our listeners, because me too, at some point before really diving into this whole world, is like, okay, what is the, because everybody thinks that their CPA can wave this magic wand and get rid of taxes, and I believe that is untrue, because you can't just eliminate taxes without doing the work that you do. And I think your work is very unique because of it being cross-functional. And by cross-functional, I'll let you kind of elaborate on that. But to kind of tee it up for you, for our listeners, when I was watching you, I mean, you literally had this entire whiteboard bubble sheet going on in your presentation about how you were moving assets into different things in order to make this happen. So it's more like a Rubik's Cube than it is just getting rid of it without waving the magic wand on the tax return. So I think to tee it up, can you explain how you approach the cross-functional, and I think it's a combination of your background and the education you've got, and how that affects the advice and how you're structuring these solutions instead of just the siloed approach?
Okay. Well, yeah. So what I like to say is that this is very specialized, and it is brain surgery. Okay, that now I'll say that there are a lot of attorneys out there and a lot of CPAs out there who work with clients, but they tend to focus on the day-to-day issues. So in fairness, they are the general practitioner. And so to give an example, is let's pretend that we're talking with a CPA. And we ask the CPA, how many clients of yours have rental property? Oh, a lot. How many times do you get a phone call every year where your client with the rental property says, oh, I just had to replace the furnace or the water heater, and I want to know if I can do a 179 deduction on it, or if I have to depreciate it over 5 years, 7 years, 10 years. How do I treat that? How do I expense that? And if you ask a CPA, how many times a year do you get that question? They're going to say, I get that, 10, 20, 30 times a year. Okay. Now ask them, how many times do you get a phone call from one of your clients that says, I have a $5 million business to sale, a $10 million, whatever it is, and I need you to do the tax planning. And when we get into the larger numbers, they may say, in my career, I may have one or two. That's it. So usually the CPA is going to be very knowledgeable about keeping the books and the issues inside the company and whether this property is depreciated this way or that way. But when it comes to the owner's perspective on selling the company, they don't really do that so much. And this is where the specialization comes in. And so, in fairness, again, to the CPAs and the attorneys out there, what's going to happen is acknowledging that they get the call about the water heater or the furnace all the time, and they don't really get the calls about I'm selling my business. Where they're going to spend their continuing education is on the issues related to the depreciability of the water heater and the furnace. They're not going to go out and learn a very complex strategy that they may only employ, 2 or 3 times in their whole career. So that's why the typical CPA and attorney is going to be unfamiliar with this. Now, we certainly do not want to take the place of the client CPA or attorney. And so this is where we get into this collaborative effort. So,
and I want to kind of dive into a couple of those things because, how many lines of tax code are there? I mean, I couldn't even begin to guess.
Well, I have a copy, so nowadays I usually go online, but I do have...
It's probably the size of a tree.
Yeah, so there's not just the Internal Revenue Code, and that's for, the feds. You also have the states, but with the feds, you also have these things called the tax regulations. And that's, if you think the Internal Revenue Code is big, the tax regulations, which is how the IRS and the Treasury Department see implementing the Internal Revenue Code, that is roughly 5 times the size.
Holy cow.
Okay. I mean, it is big.
Well, and then how many times has it changed too? And the reason I'm asking these questions is because when you talk about continuing ed, right? So for our listeners who are the entrepreneurs and the business owners, their continuing ed as entrepreneurs, mine being an entrepreneur, is market research, right? So that's what you're constantly digging up on to see the new competitors, the new things that are bubbling up. And, the attorneys, the CPAs, and anybody with a designation has got a certain amount of hours they got to do every year. Yeah. And where they spend their time, like you said, Todd, is important because so many things change every year. And that is like a brain surgeon, to go back to your analogy, not knowing that there's a new tool out that has 100% accuracy and they're using one that's got 30%.
Yeah, and so when we talk about and I'll use the broader term, disposition of a business, because the disposition might be a sale to a third party, or it might be within the family. And each of those two scenarios has very different planning methodologies. But you're right. The tax code and the tax code does have changes from time to time, and then the Treasury regulations can change. But what's really important is the tax court, the United States tax court cases, and this is where the IRS will challenge a particular strategy that's being used. And it's only after seeing the result of the court cases, because ultimately it's the courts that interpret the law. What did Congress really mean when it put in, Section 1, 2, 3, 4? I see and this is what the court says, I see the language. Now, what does that really mean? So the courts, yeah. And when you find out, you tell me.
Who's going to be the first to do it, right?
Yeah. But it's the courts that interpret the law. And so, for example, there will be, some people who try to implement a particular strategy, and then, the courts rule on the side of the IRS. On the other hand, there are specific transfers within the family that when they occur in a certain way, and it's, how it's the language is specifically written in the transfer document, but where the IRS has lost 100% of the time. Okay. And it's just, and the tax court has just made it emphatically clear, read my lips. This is how we are going to rule on this going forward. If this type of language is used, this is how, and I've got to say there's been a dozen cases on, this particular item. So what one really needs to do, well, first off, what one really needs to do is when they're going to be doing the tax structuring for a business disposition, they really need to specialize in it. Whoever the professional is, they really need to do it all day long, as opposed to, every other year someone calls me and I'll dig out the book and I'll kind of read through it. The other part of it is exactly what you were saying about the continuing education. And so not that you're necessarily going to get, a certificate with continuing education hours written on it, but you have to look to see what's going on with the tax court cases to see what is going to hold up. Now, the other side of it is, and this is actually the way that we do business, okay? Instead of, and I got to tell you, there are a lot of practitioners out there that, they approach it, well, this should work. Yeah, no, this really should work. And 2 years ago at a business exit planning conference, I sat down at one of the tables at lunch, and there was a CPA there that said, sat down. Whoa, boy, we have reason to celebrate. Oh, what's that? Well, we just passed the 6-year mark on our transaction, this one transaction. Well, that refers to a specific statute of limitations that deals with misreporting transactions. And I thought to myself, is that the way you do planning? My gosh. So what we do is we circumvent all of this malarkey about, oh my gosh, what's going to happen. There's actually a process where you can go to the Internal Revenue Service, and it's their office, what's called the Office of Chief Counsel. It's their head legal staff. And you apply for what's called a private letter ruling. And you say, you lay it out in front of them, and you say, this is the transaction or the structure that we're anticipate doing. Okay, and so it's in advance of the transaction, or putting any money into a structure, and you say, we believe, given this, that it will result in tax characteristic A, B, C, and D. And what will happen is the IRS will respond to that individual and say that they either agree, disagree, or refuse to comment on A, B, C, and D. Now, if you then get a response back that is in agreement with the characteristics that you, in your ruling request, say that you believe is, if they agree with you, you're good to go. Because once the IRS grants you that, they cannot then go back and say, oh, sorry, we're going to change our mind. Okay?
Because you got their approval.
That's right. And I'm going to tell you, it's a different ballgame. If an issue comes up in audit, they have no idea what the taxpayer's state of mind was, if they were, truly believed, or if they were trying to pull something. Mm-hmm. On the other hand, if you go in advance to the IRS and lay everything out, and essentially you're saying, Mother, may I? They're saying, well, wait a second. This taxpayer's trying to do it right. They're coming to us and getting agreement on the principles ahead of time. And what I have found is when you go for one of these advanced rulings, both the IRS and the Treasury attorneys, and they are two separate entities, but they are very collegial in the process. And they say, if there's a way for us to give this to you and help you comply with the law, we're going to help you out. And so it's just it's a different world when you go for an advanced ruling.
I'd love to see the look on their face when someone's like not trying to pull one over on them and actually trying to work with them, like what their reactions would be like.
Well, so I got to tell you, the IRS, they have an entire team of attorneys who do nothing but review these things. And I would say that in the course of a year, they probably release, a couple thousand at least private letter rulings, because some of the rulings, irrespective of, like a business disposition, it might be, as an example, General Electric going to them talking about, some aspect about their own tax return or a foreign subsidiary or, who knows. Mm-hmm. But so, I mean, these letter rulings really cover any taxpayer, corporate, business, individual who is looking for, in essence, an advanced opinion on this particular item. So I think, the process is it's routine for them now.
It's routine for them, but not a lot of advisors. And so one thing that I want to kind of demystify for our listeners is, as we're talking about these advanced plannings, quote unquote, right? So we're talking taxes, corporate structures, estate planning, like all these different things that really business owners either know because they got burned or they had someone else that was talking to them. So I don't think a lot of these subjects are overly exposed to the owner. And just to kind of a little bit of a story without going too much into it, but after watching your presentation, my dad and I realized, based on the bubble chart that you had on that presentation, is we had probably upwards of 7 figures that, we would have in our pocket had we planned correctly. But it was a combination. I mean, there's no way we would have known. It's all hindsight bias, but it was how you had the corporate structure and some estate planning with some trusts and the tax planning behind it. So there's so many different variables in it, but can you kind of distill it down to, hey, if you're a business owner with these things, here's kind of the architecture of what this advanced planning looks like?
Okay. So the first thing that I'll say is there is no cookie cutter solution. Everything is going to hinge on a specific business owner's specific situation, okay, and circumstances. You can't come in and say, like, go to Office Depot and get a standard form printed that they have there for sale for a lease or, whatever. One little change can completely alter the structure that the business owner wants to have in place. So that's the first thing. And before I get into like a specific item, I want to piggyback on something you just said about that this is not overly talked about. And so so one particular structure that we use has been around for about 20 years, and there have now been over 80 favorable rulings from the Internal Revenue Service on these structures, okay? 80. So this is, I want to say that while it involves, complex stuff, this is not like it's, oh my gosh, new and exciting. This has been around for 2 decades now. And along the line of what you just said, that what happened with your family, that we know an investment advisor in California who has a client, and they had us talk with their client. And the client had a medical device company that he ended up selling 2 years ago. He specifically asked his CPA about using a Nevada structure, and that's what we use, a particular Nevada structure to help him save taxes. And the CPA said, oh, no, you can't do that. Gosh. Didn't even investigate it. And in a similar case, there we know a principal at a partner at a reasonably sized CPA firm right in the heart of Silicon Valley with 80 people. Okay, so pretty good sized CPA firm. Mm-hmm. And when we were talking with this partner who had been practicing for 35 years, said, oh my gosh, this stuff is real. And this is when we were showing the list of private letter rulings on this one particular structure. Mm-hmm. And I said, well, what do you mean, oh, this is real? And the CPA said, well, last year we lost a client that had been with us for 20 years because another CPA firm was talking to him about this structure. And we said, no way, this is some crazy thing that, these...
they're making up or whatever, right?
It's a scam. Stay away from it. Okay. So, but the fact is that there are structures, there are things that can be done. And so, excuse me, in the simplest case, and this does depend on the state of residency of the business owner, but in general, there is a particular type of trust that one can create. And because the rules related to income tax and estate tax are different, you can actually create a trust that the assets of the trust still remain in mom and dad's estate for estate tax purposes, and mom and dad get to decide who gets the money when they die. But for income tax purposes, the trust pays its own income tax as opposed to mom and dad paying the income tax. And because the trust is a Nevada resident for tax purposes, it pays tax as a Nevada resident. And by the way, Nevada has no income tax.
Ain't that convenient?
Yes. Now, you're still subject to federal tax, of course. But what you're able to do is, and again, this varies from state to state, but if you're a California resident, a Colorado resident, and so on and so forth, Massachusetts, you are able to move your ownership of your company to the Nevada Trust. It is not a taxable event when you do it. And then subsequently, when the trust sells the business, it sells the business as a Nevada resident, and you're able to sidestep state level income tax. So that's the simplest of strategies. There's other things that come into play that you might be able to reduce the federal tax as well. And then there's the thing that I mentioned about recapture that would pull in another component of the different from this trust itself to deal with recapture of depreciated property and so on. So there's other little components that could feed on, but the simplest structure is mom and dad transfer their ownership interest into this trust, and then when the trust sells the business, you eliminate state level income tax. That's a simple example.
Which is a significant amount of money, first of all, and depending on the size of the business. But I think it was what you just gave is a perfect basic example of how all the different things matter, from the corporate structure to where the ownership is residing to the estate plan and the trust plan. So again, what you're advising on is the global family picture, and you're not just doing a tax return or doing an estate plan, making sure that, because the biggest frustration I have with when I speak to owners is they've got ingrained in them through insurance salespeople or estate planners that you need to make sure that you have enough insurance to pay for the taxes when you die. And that's what an estate plan is to people, and it just drives me nuts.
Well, so one thing that I'll say is insurance has its place, but what I also say is the skilled practitioner generally can design an estate in such a manner where you probably don't need the insurance, is the thing. So, and I mean, I'm not a real big fan of insurance, but the thing is if things are, I mean, there are absolutely situations where someone does, need insurance. Okay. But again, for skilled planners, you probably don't need it, you use other methods.
Well, and to jump in there too is, I think insurance is important if you don't have the skilled people working on your side, because you still would prefer to be covered. But you're paying whether you pay the skilled advanced planner like yourself or you pay the insurance person, you're still paying for it, right? And
yeah.
And I think one thing that I want to dive into a little bit with you is, I'm a big fan of follow the money and you find the motivation, and I live all of my relationships like that, because I do believe that everybody is inherently good, but I mean, you got to figure out how they feed their family, right? And then you figure out, okay, how is it that drives their continuing ed, or what they're recommending for you, and how they collaborate with their other advisors. And so can you give an example, like how the incentive, I think you and I've talked about some examples in the past where the different incentives conflict with the collaboration and over the general plan, and what the owner can kind of do to facilitate that, because he's got to be his own advocate.
Yeah. Okay. So this is going to be a real life story. So oftentimes, as I mentioned before, the business owner's own attorney and CPA are unfamiliar with, the issues related to M&A, mergers and acquisitions. And so a lot of times what will happen is the CPA or the attorney will say, well, we need to bring someone in who's kind of a specialist in this area. And so where, and I'm not going to mention any firm names, but I'll just say big firms. The big firms, I had an actual CPA. It was a tax partner in the Silicon Valley office of a major CPA firm. And this person said to me directly, even though we might be retained by the business seller, we really don't care about them. We don't. Now, of course, we'll get to the conflict of interest and the ethics violations in a second, and I think it'll become very evident. He said to me, and the reason is because that business seller has one deal in their life, whereas if we are representing the buyer, which might be a private equity company, it might be a public, another company, they're feeding us 10 deals a year. That's where we get our revenue. And that's whose interest we really look after. Okay? So now, in my mind, that's a professional ethics violation. But a CPA told me about a deal that he was working on. And in his particular case, he was representing the buyer, and his job is due diligence. And he interfaced with a specialist CPA who came in to help the seller out. And what he saw the seller's CPA doing is recategorizing a couple $100,000 of cash sitting in the company. So normally, you sell a company, the owner keeps the cash, and you sell off the assets. Okay, that's a typical transaction. Well, what the CPA was doing was saying, no, we've got it. That's backing up this liability that's over here, and so that has to go to the seller or to the buyer. Well, no, it doesn't do that. And what was happening was, and when the CPA that I was talking with, who was really representing the buyer, said, well, wait a second, why are you doing that? He said, because the next time around, I want to get the assignment from the private equity firm that you're representing. And so I'm doing them a favor by giving them, recategorizing this couple $100,000. Now, I would argue that crosses a legal line there.
You think?
Yeah.
My God.
But there are all of these conflicts, and the same thing with the law firms. Okay, the law firms that, oh yeah, we'll handle your transaction for you. Owners have to know that if they are using a specialist firm, and you need to use specialists, but when you're using specialist firms, whether it's a CPA or it's a law firm, they get 10 to 20 deals a year from any big company who's buying other companies or private equity firms or whatever. And they are naturally inclined to look after their interests rather than yours. And I think that's kind of maybe something that your own family has experienced. But this is a big problem. It's a big problem.
So, keep going.
Oh, well, I was going to say, I think your family has experienced it.
Well, and that's kind of what I was going to jump in with. What I experienced with my dad and I think I can relate a lot to our listeners, and even me, so more so with just my age when I was in all these meetings, because it was me and my dad in the trenches together, right? So I'm sitting in these meetings with all these bankers, these M&A advisors, you got business brokers, the attorneys, CPA firms, and I always feel inferior based on my knowledge, which I should, because they all should be way smarter in their designations than me. And, I think when I realized it wasn't just not only me and my age, but all entrepreneurs are very control freaks, right? We like to control the meetings, the situations, and the moment that we sit down in front of advisors, it just freaks you out because you're like, this guy's going to scam me because he knows more than me. Right. So, unfortunately, some of these stories prove that point. However, all of these people are necessary, and there's a lot of really good people. And so what we experienced was there was no one looking at the whole picture. Right. So we're just there. We didn't know what questions to ask. Like, hey, by the way, we've got this corporate structure. Should you look at this? Like, it's not our job. Right. But whose job is it then? And how do you align all these people and kind of hold everybody in check?
Yeah, so this is really where the exit planner comes in, or the M&A advisor, who is not the investment banker, who is not the CPA firm, who is not the law firm. This is a specialized advisor whose sole job is to really walk the owner through the process. And so they don't have necessarily the conflicted interest that the others might have. So their real job is to walk you through the process. So we are very familiar. My team is very familiar with the process. We don't want to do the quarterbacking. What we will do, though, is from the sidelines. I mean, if we see something that does look a little strange, we'll certainly tell the business owner. But we really advocate the business owner have a specialized exit planner. Then what our function really is the tax and asset protection component of the deal, and then the subsequent ownership of the proceeds. So I would say where we really go hand in hand with is with the exit planner. As many investment banks and boutique investment banks who are familiar with what we do, their real client is not the seller, it's the buyer. It's the buyer. I mean, if we're talking about an actual investment bank, so because their ready buyer is probably going to be a private equity firm. Okay, they go to the private equity firm with 10 deals a year. Now, not all of them get done, but that's who they're going to really cater to. So for us, I mean, we don't see the investment banker necessarily coming to us. It's like, I mean, if they sort of think about it, maybe they will. But really, the team really would be focused on the exit planner as the quarterback.
Well, having someone that doesn't actually have someone else's hand in their pocket, right?
Correct. Yeah.
And so one thing that I want to touch on before we take off is, so what I end up telling, and I'd like your validation or elaboration on this. So what I end up telling a lot of owners that I work with, they're like, well, everybody seems to like dive right into the technical stuff, or like, hey, I can do this move or this tactic, and it may or may not even be applicable to them, right? So it's all hearsay with all these technical stuff. What I end up saying to people, owners, because this is what my dad and I didn't do correctly, is what do you want, right? And I know it sounds so fluffy and like vague, but it's like, what do you want from your legacy to your actual wealth to where where your business goes? Because I believe that if you've got so I've got three things that I keep saying is, if you've got the time, you've got the financial stability, and you've got the effort left, you can really reverse into almost anything. And how that's done is a lot of different ways. I don't know if you want to elaborate off of that, or how you've seen interactions with your clients or examples about that?
Well, so I mean, you're actually bringing up a lot of different issues that come into play. So the question of what do you want? Really, so many times when a family-owned business is being sold, they're first off, this is the owner's baby, okay? And it's like take your child going off to college and multiply it by 10. Okay,
Yeah.
it's okay. There's a lot of emotion that's going on, and the thing that you said that you got this. The owners tend to like to control things a lot, and the thing is you're letting go here, and there's going to be a lot of self-doubt. Am I doing the right thing? And so on. The other thing that happens is in the broader family, whether it's a sale to a third party or if it's going to, ultimately transfer over to a next generation, there's a lot of emotion that's going on in the family. And if there is going to be a transfer within the family, there's going to be, I'll just say family dynamics going on.
Use your imagination, right?
Yeah, because if there's going to be some family members who are in the business, some who are not, how do we all make things equitable for everyone in the picture? So the human side of the equation is really the bigger thing. And so, I mean, get in touch with your feelings and all that fluffy stuff you mentioned, but it really ends up being the bigger part of it. The technical side of things is important, but the very issues you're hitting upon are really the main issues. And the question is what do you want to do the rest of your life? And so the more technical stuff that I do on the tax and asset protection side is important, and it gives the business owner the freedom to do whatever it is they want to do. But there is the important question, and I mean I know a couple different individuals who only specialize on the emotional side of M&A. They're not even doing the transaction and the plan. They're just handling the emotions of the family. Okay, so that's kind of interesting.
Well, I mean, I can relate because it is all. I mean, it's all emotional. When it really comes down to the final goal line. I mean, it emotion drives the entire bus, and like that's why I say, once you figure out where you stand and what you want, you can technically build, reverse back into your wishes. And again, I know that's not a lot of people like to hear because it's so vague, but figuring out the 6 inches between your ears is the most important part.
And the other thing that I'll say is whether it's the soft side of planning or the transaction itself or the tax side of things, a business owner has to be thinking about all of these things well before they're thinking about actually doing the sale. So with some of the tax things, I mean, if you already have your buyer identified, you've foregone a lot of the tax savings you'd be able to do. And I won't get into a lot of technical jargon, but you need to actually have your ownership structure and whatnot, tax plan in place before you start to shop your business. Okay, it is essential. And so similarly, addressing the emotional side of the sale and so forth. And what often happens is one day a business owner wakes up and says, I'm there. I need to sell. and then they start the process. And there are things that can be done. So forget about the tax stuff for a second. There's stuff that an exit planner can be doing, like, cleaning up the financials to get them at a point where, the buyer looks at, oh, this is great, as opposed to, well, what's this thing going on here? Okay. So there's things that really need to be done before you start shopping your company. And the more time you have ahead of the deal and so forth, the better off you're going to be, whether it's, again, from the tax side or the any other part of it.
Well, and I to just kind of put a bow on it too. I mean, just in practical terms, and I think it was an example you gave at the breakout session, but you mean if you were to go to the IRS to a private court ruling or whatever you named it is,
yeah,
you can't do that if you've already got a buyer to the table necessarily, because you have to have all this stuff in place, right? Where it's not like, oh, I'm going to move my corporate structure after I got my deal into place because it looks like shenanigans, right? I mean, it's just kind of common sense.
Yeah, there's something called the assignment of income doctrine. I won't bore everyone with an explanation of it, but what it really means is if you got a deal on the table, you're done. Okay, you're done. So, yeah, you need to do this stuff ahead of time, and so like the stuff that I do, someone could have a structure in place, sort of waiting there, and then when you then begin to shop the firm, then you're ready, everything's in place. But this is the common failure for a lot of business owners, and it relates to whether it's the issues related to the exit planning, what you do, or the tax stuff. You're saying, you know what, I am going to do all that planning. Everything they tell me I am going to do. But you know what? I got 5 years to go, and so I don't need to be doing it now. And then what happens is the letter comes in, and it says, we're going to pay you 10 times revenue for your firm. Okay, or whatever it is. But the deal you cannot pass up because it's never coming again. Okay? And so, but you've said, well, oh, but you know what? I'm not selling for 5 years, so I'm not going to do any of this planning. Okay. You have to have all of this planning, the exit plan, the tax planning, in place, ready for the out-of-the-blue offer that you cannot turn down.
Do you have any idea how many deals end up in motion because of the out-of-blue offer?
I don't. I did talk with, like in terms of percentage.
Well, yeah. The only reason I'm asking is because it just, like, we get that from what that was our situation. I mean, I know that's a lot of people's situation where randomly whether it's a third party, a private equity, a strategic buyer, like some reason someone came across that person's company and then threw an offer out there. And I gotta believe it's a big percentage versus the people that actually bring their company to market.
Yeah. So one individual who is an investment banker on the East Coast, a boutique banker, we were talking about this very subject, and while a percentage was not thrown out, he says it's very, very common. Like I want maybe a quarter or a third of the deals that he sees are of this out of the blue, mm-hmm. and you're stuck at that point.
So, in order to kind of keep on pace, what is one thing that we haven't touched on that you'd leave our listeners, the business owners of the U.S., with for things to take into consideration or things to do? What would be the one thing that you should leave them with?
Well, really, they need to be talking with an exit planner who's going to be the quarterback, and really get that person online to help them through the process. That's what I would say.
Love the plug, by the way.
Yeah, no, but I mean, you have the person who is in who does nothing but help a business owner through the whole process. And these are the steps you need to be doing. And before we even bring the investment bank person in the picture, we need to do all these things to clean up your books, make sure like payroll taxes are paid, or if the business is a retailer, make sure that all of the sales tax is done. Because, just a quick note, let's say that you sell stuff on the internet and somehow, some way, you sell stuff to, I'm just picking this up, Wisconsin. And Wisconsin says that, well, even though you're not present in the state, you have a responsibility to collect Wisconsin income tax and forward it to us. Well, what if you haven't been doing that? Okay. And that's just a simple example of that, or what happens. I mean, it could be an array of anything that could come up. And so what you really want to do is identify the little snags in your firm before you start selling it. And, it's sort of like but when you're going to sell a house, this is probably a great example. If you're going to sell a house, you don't let the buyer simply do the contractor inspection. Before you list the house, you do your own contractor inspection. You identify where the leaky pipes are, whatever it is, and you fix them. So that when the buyer does their contractor inspection, say, oh, they've got a clean bill of health. And then then the buyer feels real confident. That's what you want to do. And the contractor inspection is the exit planner. Okay?
I love it. Well, Todd, I appreciate the time and the wisdom today on the show.
Absolutely. It was great. And for all those out in listener land, you definitely want to hook up with an exit planner and let them help you through the process.
Thanks again, Todd. Appreciate it.
Okay.